Okay, and welcome back, students who are taking financial accounting. And in this series of videos, we are working on the assigned homework problems from the digital study guide for Chapter 9, problems from Group B. Note, accounting is about understanding the concepts and then applying that understanding to the situation at hand. If you get the application aspect wrong, that is one thing and is easily remedied by watching someone else work the problem. However, if you don't understand the concepts, that is a whole other thing. Watching a problem worked out will not help you if you don't understand the underlying concepts. Go back and study the text material again and watch the theory videos. If you still don't understand the concepts, then either email or telephone an instructor to get help with that understanding. All right, so we are working on problem 9-48. Let me get my pen. Right, and it says here, analyze bond terms and accounting for bonds. Right? And again, if you don't understand the theory behind this as I work the problem, go back to the theory videos because I cover it there. All right, and I also cover it in the math for business and finance. This is the second time that you're looking at bonds. So if you're not getting it right now, you need to get it, because even just last night I had someone who was in financial management and they were looking at it, the information, it was a simple, it was a bond chapter, and they're like, well, how do I do this? Well, by that point in time, they should have known how to do that, and they weren't getting it. So go back and watch the theory from Math for Business and Finance or Math Applications, and definitely watch the theory videos for financial accounting, because I'm not going to cover it all. All right, so I'm not going to cover it again, I should say. So assume that March 1st, Simmons Corp issues an 8% 10-year bond payable with maturity value of $900,000. The bonds pay interest on February 28th and August 31st. So let's draw a quick timeline here. This is March 1st, okay, of 2014. Pays on August 31st. Okay, so that's 6 months. And then also on February 28th. So that's an additional 6 months. But also notice that right here is year end. All right, so that needs to be considered. So we have a $900,000 bond, and it's at 8% for 10 years. So 10 years times 2, that means there's going to be 20 interest payments over the life of that bond. So Simons amortizes any premium or discount by the straight line method. Okay, so like I said, go back and watch the theory videos because we covered amortization using the straight line method. And it says here the fiscal year is September 30th. All right, so we have a fiscal year of 9/30 right here. Okay. All right. Yeah, and also go back to the exercises. There was a couple exercise problems that we had where we amortized using the straight line method. All right. So if the interest rate is 7.25% when Simmons issues its bonds, will the bonds be priced at par, at a premium, or at a discount? And explain. Right. Well, if it's right now the bond is at 8% and the market interest rate is at 7.25%. Okay, and that means that the bond is selling at a premium, right? Because you're getting more than what the market interest rate is. And so, and when you look at the solution, I mean, it does tell you the 8% bonds, when the market interest rate is 7.25%, will be priced at a premium because they pay interest at a higher rate than the market rate. Investors will pay a price above the maturity value to acquire them. So yeah, this here is the par value, and because the market interest rate is lower, they're going at a premium because they're getting a higher interest rate. Right. So number 2, if the market interest rate is 9.5, when Simmons issues its bonds, will the bonds be priced at par, premium, or a discount? Well, again, if it's at 8 and now it's at 9.5%, right? Those bonds are at a discount to the market rate, right? Because it's lower than the market rate, right? People who are buying it at 9.25% with the interest rate at 9.5%, they're not getting the full value of the bond itself. The bond is only paying at 8%, so they're getting it at they're getting at a discount to the market rate. Okay, it just occurred to me that pay attention. All right, if when you have to think about what par is, okay, and you have to think about what this the stated market rate is, right, and its relationship. When you watch the theory videos, we kind of said, okay, if the interest rate was 9%, you're getting it at a premium because it's above the par. Okay, but here I'm telling you it's at a discount, right? Because we're talking about the market rate being 9.5%. We're not talking about what you're getting for the interest rate on the bond when they're being sold at that point in time. So be aware of the terminology and think about it from a market perspective. Okay. All right. Assume that the issue price of the bonds is $924,000. Okay. Journalize the following bond payable transactions. All right, and I'm going to do this, but I'm going to pause and erase where necessary. Okay. All right. So if the bond is at 900,000, right? And we're issuing it on 3/1, so it has a maturity value of 900,000. Okay, but we're getting assume that the issue price of the bonds is 925,000, so we're getting cash for 924,000. Sorry. Okay. But we're going to owe at maturity value 900,000, so we're going to credit our bond payable for 900,000. Okay, the difference between the two, debits have to equal credits, is 24,000, right? So we're going to credit 24,000 to the premium that we're getting on the bond payable. Okay, again, be cognizant of the terminology that we're using here. We use the words premium and discount in a couple of different ways. I just was talking about a premium on interest rates, right? And now I'm talking about a premium on the sale of the bond itself and the amount of money you get. We were talking about 8% was par, and if we're getting 7.25%, we said that's going at a premium over the market rate. Okay, and here we're talking about a premium based upon the dollar amount of the bond itself. Okay, so we're getting more cash on the bond itself. Here, when the person buys the bond, if at 8% and the market is only at 7.25%, they're making a 0.75% spread that the market isn't giving them if they go and stick that money in the bank. Okay. All right, so pause the video there, and I'm going to erase this journal entry. Okay, so that was A. Okay, now B says payment of interest and amortization of the premium on August 31st. All right. Okay, so first, we're looking at, what are we looking at here? Okay, so we just did the issuance of the bond, all right? Now we're looking at this here first payment, all right? So we're going to pay interest at that time. And so how much interest are we going to pay out? We're going to pay out the I'll do it over here in this space here, 900,000 times the 8%, and that's times the 6 month, because this is semi-annual, right? Over, sorry, not 20, over 12. And that means the amount of interest is going to be $36,000, okay? So we are going to pay out in cash. So we're going to credit our cash for $36,000. 36,000. All right. Now, that's not, normally you would, we're paying that as interest. So we know we're going to debit our interest expense. But the interest expense is not just $36,000. We have to take into consideration the premium, okay, that we had on the bond payable. Right now, as you recall, right, we have a premium of $24,000. Why? Because the bond was a $900,000 bond, and we're issuing it at a price of $924,000, right? So there's a $24,000 difference in a premium. That premium needs to be amortized, okay? And that amortization will go against a debit, because debits have to equal credits. So we'll debit the premium on the bond payable. Okay. And 24,000 divided by the 20 periods that we're going to have for the interest gives us $1,200 for each period that we're amortizing straight line on the bond. And now the easy way to do this is debits have to equal credits. So I have a credit of 36,000, and I'm subtracting out $1,200 because that's a debit. This is a credit. This is a debit. That means I end up with $34,800 as my interest expense. $34,800 as my interest expense. Okay. So that's how we do that particular journal entry for the payment of interest and amortization of the premium on August 31st. So pause the video here, and I'm going to erase this. Okay, so all right, so C, okay, we have the accrual of interest and amortization of the premium on September 30th. So now we're right here in the timeline, okay? This is when September 30th, is their fiscal year end for September 30th. So we have to accrue the interest for that one additional month, okay? Right, to do that, right, it's 9/30. Right. Now, we're not paying out the interest, okay? We're accruing it, right? So that means we're going to credit interest payable because we're going to still owe that money, right? And we arrive at the figure of 900,000 times the 8%, but now it's for only 1 month out of the 12. So times 1 month out of the 12. And if we do the math, we end up with $6,000. So our interest payable is $6,000. Okay. Now we also have to do we're accruing the premium, all right, on the bond payable, all right, and because remember that premium of $24,000, all right, you know, that is we're accruing that amount because that's going to be part of our interest expense, right? So we have 24,000 divided by 20, right, which gives us $1,200, right? And that $1,200 is that's for a 6-month period. So we multiply that by 1/6 because we only need a 1-month period, and we end up with $200 is our premium on the bond payable as a debit. And of course, debits still have to equal credits, and we're dealing with the accrual for the interest. So we're going to debit our interest expense. And again, it's just a matter of backing into these numbers. I have a credit of $6,000, and then I subtract out $200 because that's a debit. And that means I have interest expense of $5,800. Okay, so pause the video, and I'm going to erase this. Okay, so now we're down to the last entry there. And the last entry is the payment of interest and amortization of premium on February 28th. So we're here on February 28th. I wrote in the calendar date, calendar year ending here, right, before I knew that it was a fiscal year end of 9/30. Because it's a fiscal year end of 9/30, I don't have to mess around with the calendar year, because the year goes from October 1st all the way to September 30th for this particular company. That's what fiscal is, right? Calendar is from January 1st to December 31st. They're not using the calendar year, they're using the fiscal year. So our next entry is going to be here for February 28th. And it's the payment of interest and amortization on February 28th. So, when that person comes in for bringing in their second coupon for that 6-month period, right, we're going to credit cash again because we're going to pay out the cash. And remember that cash was $36,000. It's the same as the same amount as what was paid on August 28th as part of the journal entry. But let me do it again. 900,000 times 8% times 6/12 is 36,000. So we're going to pay out to the holder of the coupon for 36,000. Okay. Now we have to wash out the interest payable from the previous journal entry, right? So we're going to debit our interest payable for the full 6,000. That takes it off the books because remember, we were accruing that amount, that 6,000. Okay, so we have to take that off the books, right? And then we also have to do the premium. We're going to debit the premium on the bond payable, right? And to get that, right, we're taking the 24,000, right? Remember the 24,000 is the difference between the 900,000 and the 924,000 right there, which was 24,000. And that 24,000, we're dividing that by 20. So 24,000 divided by the 20, right, gave us $1,200. Okay, but remember, when we did this for September 30th, we took 1/6 of it at that time, okay, because we were accruing it. Well, this time we're going to take the remaining 5/6, okay, the remaining 5 months. So 1,200 times 5 and then divided by 6 is $1,000, right? So the premium on the interest on the bond payable is $1,000. Okay. If you'll recall, when we made the entry for the August 31st, the first 6 months, that premium, the amortization of the premium was $1,200, right? But when we did the accrual here, we had 100, and now we had 200, sorry, and now we have an additional 1,000. The two add together, make up the $1,200. Okay, so um, remember that's because we're doing that because of the accrual. All right, you only have to book the unaccrued portion because we already expensed that $200 as part of the interest expense. And of course, debits have to equal credits, so I'm going to debit. And what's all this go to? It goes to interest expense. So I have 7,000 for my debits and 36,000 as a credit. I have a debit of 7,000. The difference between the two is 29,000, so my interest expense ends up being 29,000. Okay, and that's the entry that's going to be made for the 228. Right. So that's it for this particular problem. Again, go back and watch the theory videos. If you didn't get, and if you're going along here, you can just copy along and follow the math. But if you're not understanding why it's being done, you need to go back and watch the theory videos. And if you still don't get it, feel free to contact an instructor. Okay? See you in the next video.